Hello everyone. Now let's continue chapter 2, which is about analyzing transactions. And now we'll cover the double entry accounting system. So double entry accounting system is a system that's created specifically for accounting. And basically it says for every single transaction there are two accounts affected. One would be on the debit side and the other would be on the credit side. So all businesses use what is called the double entry accounting system. So this system is based on the accounting equation. Every business transaction is to be recorded in at least two accounts. And please remember that. It has to affect at least two accounts. There's no way one account would be affected. So if I purchase, let's say, a building, I would acquire a building and I would give up cash. So there are two accounts that are affected. Every single transaction is like that. The total debits recorded for each transaction is equal to the total credits recorded. It has to be that way. So whatever is recorded on the debit should always match what's recorded on the credit. So the double entry accounting system also has specific rules of debits and credits for recording transactions and accounts. So let's see these rules. So as you can see here, we have the balance sheet accounts, and these accounts are assets, liabilities, and stockholders' equity. So when we first introduced the T account, it was for the account cash, and by the way, cash is one of the assets. So we use the T accounts here, where we have the debit side, which is the left-hand side, and we have the credit side, which is the right-hand side. So for the debit side, we recorded any increase in cash. So I want you to remember that this rule applies to all assets. So the debit side of an asset is the increasing side, and the credit side of an asset is the decreasing side. So if I want to increase the value of an asset, I would record it on the debit side. If I want to decrease the value of an asset, I will record it on the credit side. The opposite is true for liabilities and stockholders' equity. I would like to call it the credit side is the good side for liabilities and equity. So whenever we want to increase a liability or a stockholders' equity, we are going to record this increase on the credit side. If we want to decrease the liability or stockholders' equity, we are going to record the amount on the debit side. So try to remember this on the accounting equation. The accounting equation has assets, liabilities, and stockholders' equity. We have the equal sign. So hypothetically, imagine that there's a line here that splits the asset side and the liabilities and equity side. And the asset side, since it's the left side, it likes the left side, so that's why the debit side is the increase, or where we increase the value of assets. Liabilities are on the right-hand side. They're the ones that like the credit side. So whenever we want to increase a liability or we like to increase an equity, we increase it on the credit side. And the decrease would be the opposite side. Now let's look at the income statement. And the income statement affects stockholders' equity. So whatever is good for stockholders' equity would be good for accounts that are related to the income statement. So now let's think about revenue. Revenue is something that would increase the stockholders' equity, and because it increases the stockholders' equity, it follows the same rules. So the credit side is the good side for revenues, and the debit side is the bad side for revenues. When I say that bad side, I mean like it's the side that would decrease it. Expenses has an opposite impact on stockholders' equity, and this is why it works on the opposite side. So debit is the side that increases expenses, and credit is the side that decreases expenses. So the debit and credit rules for income statement accounts are based on the relationship with the stockholders' equity. I want to remember that. And stockholders' equity, the good side for them, or the positive side for them, is the credit side, unlike assets. The rules of debit and credit for revenues and expenses accounts are as follows, which is just basically as I just explained. So remember, the credit side is the increasing side for revenues, and the debit side is the increasing side for expenses. And the debit side is the decreasing side for revenues, and the credit side is the decreasing side for expenses. How about dividends? Dividends also has a negative impact on stockholders' equity. So because of that, it's going to follow the opposite direction of stockholders' equity. So you can see here that debit is the increasing side for dividends, and credit is the decreasing side for dividends. So the debit and credit rules for recording dividends are based on the effective dividends on stockholders' equity. And by the way, it's indirectly affecting retained earnings. The rules of debit and credit for the dividends would be as I just mentioned. The positive is the debit side and the negative is the credit side. So to summarize, I think this is a good summary here. We have the balance sheet and we have the assets, liabilities, and stockholders' equity. And here we have the income statement and the dividends. So remember, assets, the green side is the side that they increase for. So the debit side is what increases, or this is where we record the increases for assets. For liabilities and stockholders' equity with its two components, common stock and retained earnings, the credit side is the side of increase. For income statement, we have the revenues and expenses. Revenues, they follow the same rules as stockholders' equity, where the credit is the increasing side, the green side, and expenses, they follow the opposite rules of equity. So their debit, or the debit, is the side where it increases. The same thing for dividends. So dividends, it increases on the debit side. So something to remember: assets, expenses, and dividends, they increase on the debit side. Liabilities, stockholders' equity, and revenues, they increase on the credit side. So that's the summary of that. And of course, the opposite for credit. So one more time: assets, expenses, and dividends, they increase on the debit side and they decrease on the credit side. For liabilities, equity, and revenues, they increase on the credit side and they decrease on the debit side. So I think this chart here is a good friend. You have to maybe print it or keep it next to you. Maybe try to copy it and have it next to you while you go over the transactions. So journalizing is the first step in any accounting process or in any accounting cycle, where we journalize the transactions. By journalizing, we mean that we record the transaction in a record called the journal. So using the rules of debit and credit, transactions are initially entered in a record called a journal. So please try to remember that. This is our very starting point. In the journal, we record the transactions on the debit and credit side, and this process is called journalizing. So the journal serves as a record of when transactions occurred and were recorded. So let's go over the transactions that we had in Chapter 1, and let's try to record it in the journal in a formal way. So on November 1st, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for common stock. So you can see here we have date, we have a column for description, a column called post reference that we're going to use later, and then we have two columns, one for debit and credit. The debit is the left hand side and credit is the right hand side. So in the journal, we're going to record the date that this transaction took place, which is November 1st, and that's step number 1. In step number 2, we're going to record the transaction that got affected, which is cash. Okay, so cash in this case was recorded. Remember, cash is an asset, and assets, whenever they increase, they are increasing on the debit side. So here we have assets, we have cash, and on the debit side, this is the T account. We can see that it's recorded on the debit side, on the left-hand side. Okay, and we record $25,000 on the debit side. The other account that was affected was common stock. And if I can just do a quick flashback to this here, see the two accounts that were affected when Chris Clark invested $25,000 in the business were the $25,000 cash under assets and $25,000 under common stock. So let me go back here. So the other account is common stock, and common stock is also increasing. But remember, common stock is part of the stockholders' equity. They like the credit side, or in other words, they increase on the credit side. So that's why we record the $25,000 on the credit side. So this would take us back to the double entry bookkeeping system, or accounting system, where every transaction affects two accounts at least. Could be more, but at least two accounts. One should be recorded on the debit and the other should be recorded on the credit. So we can never have a transaction or like recorded in the journal where the two accounts are recorded on the debit side and that's it. No, we cannot do that. It has to be one on the debit, one on the credit. In some cases, we might have two accounts on the debit and one account on the credit for the total. But whatever the situation is, whatever we have on the debit should match whatever we have on the credit. In this case, we have cash and common stock. So cash is an asset. Common stock is a stockholder's equity. Cash increased by $25,000. Common stockholders, or common stock, which is under stockholders' equity, increased on the credit side by the same value. And that's how we present it. And then we write in step number 4, like just a brief note saying issued common stock for cash. The post reference would be used later when we post to the next record we have an accounting, which is called the ledger, okay, or the general ledger in this case. So again, in this slide we just go over the steps. The date of the transaction has to be entered. The title of the account to be debited is recorded with its value, and then the title of the account to be credited is recorded with its value, and then a brief description is written, and a post reference column is left blank until we post to the ledger. And by posting we mean like transferring the value from the journal to the ledger. Some terminologies that we have to pay attention to hopefully would be useful. So things like receiving cash for service provided. When we see that, you always remember, we receive cash when we provided service. So we debit cash and we credit fees earned. Fees earned is a revenue, okay, and cash is an asset. Also something like service provided on account. So in this case would be debiting accounts receivable, crediting fees earned. I think the slides here are slightly shifted. And then received cash on account. So we debit cash and we credit accounts receivable. Purchases on account. In this case we made some purchases, so we got the asset and we didn't pay for it, so we use accounts payable. So these are two accounts that we are going to talk about now, like accounts receivable, accounts payable. So whenever we owe someone that we bought something from them, then we call it accounts payable. If somebody owes us money, we call it accounts receivable. Something like paid on account. Whenever you see the word paid, or received, remember that cash is involved in this process. So paid on account, accounts payable is going to go down and on the debit side, and then we also reduce cash since we paid. Something like paid cash for buying an asset. So we bought an asset, or we paid an expense and we credit cash. The word paid is easy because that would tell us right away that we have to credit cash. Whenever we receive cash, remember cash would be on the debit side. So now let's see transaction B. Transaction B here, it says Net Solutions paid $20,000 for the purchase of land as a future building site. So we bought land and we paid it for cash. So land is an asset. When assets go up, what's going to happen to it? We record it on the debit side. What is the other account that we used? It's cash, because we paid $20,000 in the form of cash. They say, hey, here, paid. So since we paid, cash is going down, and cash is also another asset. Assets, when they go down, they go on the credit side. So you see here, these two T accounts, we have the land and we have cash. Land is debited for $20,000, cash is credited for $20,000. So how we record the journal entry, November 5th, which is the date. We debit land, we credit cash, and we write this brief note, purchasing land for building site. So we debit land for $20,000, we credit cash for $20,000. Okay, so you can see here, whatever was debited is, we have an equal balance for a different account with the same amount. Let's see transaction C. Net Solutions purchased supplies on account for $13.50. So the only difference here, we didn't pay in cash. It's on account. So we have a promise to pay them in the future. This is a liability created now, and we call that accounts payable. So any payable, that's a liability. Any receivable, that's an asset. So when someone promised me to pay me in the future, that's accounts receivable. When I promise someone to pay them in the future, that's accounts payable. So the two accounts are supplies and accounts payable in this case, based on this transaction. The supplies is an asset. It's going up because we acquired new supplies. So it's going to be debited for $13.50. For liabilities, we have accounts payable. It's also increasing, and remember, liabilities, they like to increase on the credit side, so we're crediting $13.50 here. So debit supplies, credit accounts payable for $13.50, both sides, and then we have this brief note, purchase supplies on account. Remember, always, 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 whatever is on the debit should match whatever is on the credit. We cannot have two debits, or we cannot have two credits. And we need to have at least two accounts recorded. Let's see transaction D. I see the word cash. It says here, Net Solutions received cash of $7,500 from customers for service provided. Received cash, so cash went up, right? And fees earned, this is a revenue. Revenue is part of, exactly, it's part of stockholders' equity. It increases stockholders' equity. So it follows the nature of stockholders' equity. So it also increases on the credit side. So cash is increasing. We debit cash for $7,500. Fees earned is increasing. We credit fees earned on the credit side for $7,500. So on the accounting equation, we have the T account for cash. It's debited for $7,500. The T accounts for fees earned. It's credited under. It's under stockholders' equity here. It's credited for the same value, $7,500. Let's see transaction E. And by the way, we did all these transactions in chapter 1, and that's why I'm going through them a little bit quicker. But I want you to pay attention to the idea of debit and credit now. So Net Solutions incurred the following expenses. And when we incur the expenses in this case, we also pay them all. So we paid the expenses. We had wages, we had rent, we had utilities, and we had miscellaneous expenses. So all these expenses, as we've talked about it before, should be recorded on the debit side, because whenever expenses increase, they are recorded on the debit side. And how did these expense accounts impact cash? Did they increase cash or decrease cash? Of course, when we pay for these expenses, cash is going to go down, and that's why you see cash. And the T account here is recorded on the credit side for the total of these expenses that we had. And then all these expenses, each one of them has its own T account, and we recorded the $21.25 for wages expense, $800 for rent expense, $450 for utilities expense, and $275 for the miscellaneous expense. So the total, when we add them up, that's the amount of cash we paid. How we record the journal entry for this? Remember, whatever we have on the debit should match what we have on the credit. And in this case, we have a list of accounts that are recorded on the debit side. They're all expenses. So we have wage expense, rent expense, utilities, and miscellaneous expense. And we record their values on the debit side, and then we credit cash for their total, which is $36.50. And now the debit matches the credit. And then we have this brief note here that says paid expenses. By the way, paid expenses is not an account. It's just a note that we have at the bottom here. So transaction F, Net Solutions paid creditors on account $950. So they paid. So what happened to cash? Cash went down, and when cash goes down, it goes on the credit side. Cash is an easy account to relate to. When it goes up, it goes on the debit side. When it goes down, it goes on the credit side. So when we receive cash, it goes on the debit. When we pay cash, it goes on the credit. So in this case, we paid creditors on account, those who owed us money, the accounts payable. Remember, we paid part of it, so we paid $950. So we expect that cash is going to go down on the credit side, and accounts payable is also going to go down. But remember, accounts payable is a liability. When they go down, they go on the debit side. So on the journal, we record the date, November 30th. Accounts payable, $950 on the debit side. Cash on the credit side for $950. And we have this brief note that says paid creditors on account. Right, let's see transaction G. This is where we bought some supplies. Or actually, we had the supplies, but we used the supplies. So Net Solutions determined that the cost of supplies on hand at November 30 was $550. Remember, we originally purchased supplies worth of $13.50, and now our leftover is $550. So how much did we use? It's the difference. We originally had $13.50. We are left with $550. So what we use is actually $800. So we need to record the amount of supplies we used during the period. So on November 30th, we debit supplies expense and we credit supplies. Remember, supplies expense, it's an expense, it's an account that reduces stockholders' equity, so their nature is on the debit side. They like the debit side whenever they're increasing. Supplies is an asset. When we use it, it goes down, so it has to go down on the credit side. So this is why on the T account under assets, supplies went down by 800. Remember, we originally had 1350, it went down to 550. So we need to record the difference as the amount that was used or consumed out of supplies. So we credit supplies by 800 and we debit supplies expense, which is a separate account, by the way. Supplies without the word expense is an asset. Supplies expense, it's an expense account that has a negative impact on stockholders' equity. And that's why it's recorded on the debit side. So we debit supplies expense, we credit supplies on November 30th by 800, and we write this brief note, supplies used during November. One thing I want you to pay attention to is that whenever we record a journal entry, that, by the way, we call that a journal entry, and it's written here, journal entry, and that's recorded in the journal. Whenever we record a journal entry, we should always start with the debits and then record the credits. I might think credit first and then think about the debit, but whenever I'm presenting them, I have to start with the debit and then go for the credit. So you can see me here, like I talked about the asset, supplies, it went down by 800, so it went on the credit side, and then I talked about the supplies expense. And when I'm presenting it, I have to start with the supplies expense, and then, which is on a debit, like this is how it's recorded in the journal, we debited it for 800, and then we credited the supplies for 800. Now let's see transaction H. This is where we paid dividends for $200. This transaction decreases assets and stockholders' equity. Okay, so this transaction is recorded in the journal as a $2,000 increase to dividends and $2,000 decrease or credit to cash. So remember, when we pay cash, what's going to happen to cash? Cash goes down, and it goes down on the credit side. So that's the cash T account here. It goes on the credit, $200. Dividends, it has an opposite nature to stockholders' equity because it reduces stockholders' equity. So that's why when it increases on the debit side. And in this case, we're increasing our dividends. We're paying more dividends. So the dividends are on the debit side. Little trick, dividends start with the letter D, like debit. So whenever you see dividends, always remember, usually we record it on the debit side. So we debit dividends and we credit cash for the 2000, and we write this brief note that says paid dividends. Okay? So let me stop here. In the next video, we're going to talk about posting journal entries to accounts. So we'll see how the journal entries would be posted to the ledger.